Group Statements, Chapter 5, Example 5.1. This example looks at the scenario where there's a sale of intragroup inventories by the parent to the subsidiary company. P Limited acquired a 70% interest in the net assets of S Limited on 1 January 20X9, which is my acquisition date. The trial balance on the acquisition date identify the investment in S Limited at 25,000 Rand and the at acquisition equity of the subsidiary of share capital 22,500 Rand and retained earnings of 7,500 Rand. Then the example provides you with the trial balance on 31 December 20X11 of each of the companies, which is a few years after acquisition date. On this trial balance, I want to highlight the investment in S Limited that is still carried at 25,000 Rand. The share capital of S did not change and it's still 22,500 Rand. The retained earnings opening balance of the subsidiary has changed now to 42,500 Rand because time has passed. And it's important to note that that represents the opening balance retained earnings. The reason for that is that the profit and loss items is still also included in the trial balance, meaning that it is not closed off to retained earnings. Other amounts that we're going to use later on, the profit for the year of the subsidiary on the trial balance is 65,000 Rand. And then it also provides you with a breakdown of the profit number of both the subsidiary and the parent company. In the additional information, I want to focus on a few things. The accounting policy of the two companies are identical. On 1 January 20X9, that is my acquisition date, the identifiable assets and liabilities of S were considered to be fairly valued. We would look at a scenario where it's not the case when we look at Chapter 7. NCI at acquisition date is measured at their fair value of 10,000 Rand. It is P Limited's accounting policy to account for investments in subsidiary at cost in its separate financial statements. That is why we see the investments still measured at 25,000 Rand at the end of 20X11. The focus of Chapter 5 is on intragroup inventory sales. In this example, the intragroup inventory sales was by P Limited to S Limited at an agreed profit margin of 10% on cost, and the total amounted to 70,000 Rand for the year ended 20X11. Important information from this: P Limited is the selling entity. The gross profit margin of 10% on cost is the profit markup of the selling entity, and the total purchases is 70,000 Rand. It is important to identify the selling entity for purposes of measuring profit and equity attributable to NCI later on. The next thing that's important to identify is whether the buying entity still had some inventories on hand. The buying entity, being S Limited, had the following inventories on hand that were purchased from P Limited. The moment you see that, you know that included in those inventory balances is a profit amount that's still unrealized for consolidation purposes. On 31 December 20X10, that was the end of the prior year, the 4,400 represents the inventories on hand at the end of the previous year. That represents the inventories on hand at the beginning of the current year. In both the 4,400 and the 6,600, there will be an unrealized profit included in these numbers. Because it's still on hand, it includes a profit charged by the parent company that is not yet realized for the group. The 4,400 will have an unrealized profit in opening inventories effect, and the 6,600 Rand will have an unrealized profit in closing inventories effect. Let's start with a consolidation process. We do not have any adjustments necessary with regards to different reporting dates or accounting policies, and we also do not have business combination valuation journals at this point in time, which is the topic of Chapter 7. For consolidation purposes, line by line, we always combine all balances and totals and giving effect to adding 100% of P to 100% of S. This happens on the consolidated financial statements line items. We do not make use of a consolidation worksheet in this example anymore. The first journal is always your at-acquisition consolidation journal. The effect of Chapter 5 is that it doesn't have any impact on the at-acquisition consolidation journal entry. You are still eliminating the total equity of the subsidiary against the cost of the investment by the parent. We measure NCI either at fair value or their proportionate share. The fair value was given as 10,000 Rand in this example, and we have balancing goodwill. This journal entry did not change from any previous examples. It is still the basic at acquisition consolidation journal entry. Now we look at the intragroup journals. The intragroup journals achieves the elimination of intragroup transactions. The only intragroup transactions in this example was the intragroup revenue and sale of intragroup inventories. The first journal entry relates to the elimination of the total sales and purchases in the group. The journal entry is debit revenue of the parent being the selling entity and crediting cost of sales and ultimately the purchases by the buying entity being the subsidiary for the full 70,000 Rand. This journal entry is necessary regardless of whether there's any inventory still on hand and any resultant unrealized profit. This first journal gives effect to the elimination of the total sales and total purchases in the group in the current financial reporting period.